Very much, Peter. It's a pleasure to be here and especially to follow Mark. Mark's macro view of the world economy is very consistent with what we've been looking at for this next presentation. So we'll just focus back on the industry a bit more now, following that global overview. It's been a pretty rough ride, and especially since the global financial crisis. But the warning signs were much earlier, actually. The peak in the export price average in Australian dollar terms was the beginning of the 2000s. And the blue line there shows you the average Winegrape price, which followed very closely that up and then that down in the export price for Australian wine. And the red lines are showing you what was happening to bearing acreage, and that continued to grow for another 7 years after that peak. So it's not surprising that we've got this big oversupply that we've been trying to get rid of for quite some years. This is, of course, one of many cycles. We've had 5 or so in the Australian wine industry. If you go to France, they've probably had hundreds. It's a very standard thing. These data here give you a relative view of that cycle compared with other ones, where we're looking at, for example, vine area, bearing area in blue, relative to total crop area in Australia. So over the last 170 years, you can see how much the grape acreage has grown relative to other crops and then collapsed after a peak. This current boom is one of the longest, and you can see how much it's declined in that last part of the slide there. The red line is wine production relative to total production in the economy. And again, you can see very clearly those cycles. So if you'd had a look at history, you would have been anticipating us having this type of cycle. Although people were assuming perhaps that because this had become a market-driven cycle, a market-driven boom with an export focus, that being a small supplier into the world markets would help us to not go through such a cycle, but nonetheless it has happened. We just had too much exuberant investment early on, and too much wine has been sitting around to get rid of. As Peter mentioned, the exchange rate's been a really important reason for that decline in the Australian dollar price of our exports. And if you just look at the period since the GFC through to 2011, the euro basically stayed the same in real terms to the US dollar, but the Southern Hemisphere exchange rates appreciated relative to both the US dollar and the euro, but Australia's dollar appreciated in real terms more than any other Southern Hemisphere exporter, and that's why we just had this much sharper downturn perhaps than others. So we used our model going backwards to have a look at. We have a model of the world's wine market subdivided into 5 different categories of wine. If you look at the first column on this table, shows you the extent of that change in the real exchange rate. So in Australia's case, it was a 33% appreciation over that period from 2007 to 2011, and it depressed prices by about 1/3 for both grapes and commercial premium wine, and about 1/4 for even super premium wine. So that's been a really major part of the downturn we've had in recent years. And that downturn, even when you express it in US dollars, can be seen here. This is the total value of our exports in blue there, which peaked in 2007 and then shrunk badly, while all the other competitor countries were still expanding. So it was not a shrinkage in the world's wine market that was causing our downturn. It was we were losing competitiveness relative to other wine exporting countries. So where can we go moving forward? As Mark suggested, probably there's not much growth prospect in the domestic market. We've got an adult population that's growing only through immigrants, and those immigrants tend to be non-wine drinkers. Our incomes are probably going to go backwards in per capita terms over the next few years unless our government gets into reforming the place a bit more. This is because of the end of the mining investment boom, and the adjustments that are needed there are just going to cause incomes to be very sluggish domestically. And of course, we've got this very strong anti-alcohol health campaign here and in other countries, but that here is also potentially going to damage demand growth, especially if we get a rise in taxes on domestic wine, which they are pushing for. So it's going to be a matter of relying on exports and our competitiveness in those export markets, as Peter mentioned in the introduction, is going to depend very heavily on trends in real exchange rates. But over the past 3 years, we've seen this decline in the Australian dollar, and that's going to be very helpful. In addition, China is going to be a big part of the story, and Peter asked me to have a look at that as well. So there's the change in the nominal exchange rates recently, peaking around 2012 and declining substantially since then, coming back towards those levels of 2007 or even further back. Oops. Looking at Asia first, China is the growth story there. The Japan line is the red one. You can hardly see any upward movement there, although it did come up a little bit in the last couple of years. But China is dominating. India is about 1/50th or something of the size of the Chinese wine market. So China is where all the action is going to be. We can sell high-priced wines into the smaller Asian economies, but the aggregate of them is in that green line. At least the Northeast Asian ones is in that green line, and that's pretty small compared with the blue line. And not surprisingly, Australia has been able to benefit from that, and this is the growth in Australia's Australian dollar value of its exports to China and Hong Kong over this recent time. So, of course, the Hong Kong market grew a lot after they abolished their tariff back in, I think it was 2007. So where are we going to get to by 2020? That was the question Peter asked me to look at. And so we've done some modelling. It's only preliminary work, but we started off by doing a couple of exercises. One was to say, where would the markets be using this global wine model if there was no change in our real exchange rates from, say, 2012, and then compared that with what it would be with a substantial realignment of exchange rates. And we took as our example there the change in exchange rates since 2012 to today, to the middle of this year, where we've had this 20 or 30% decline in the Australian dollar, but lots of changes in other real exchange rates as well. And we'll look at the impact of that, and then we'll look at the impact of some FTAs that have been introduced recently. So, as I said, this base scenario is looking at forward to 2020, firstly assuming no exchange rate changes, and then assuming that exchange rates do move back to where they are today, and then they stay where they are today for the next 5 years. So here's a similar table to that one we saw before, with the change in the exchange rates in the first column in this scenario. So it's for Australia a 27% decline in the real exchange rate, which is much bigger than for the other competitor countries there, and hence it will have, as you see on the bottom line there, this substantial impact on the prices of grapes and wine, and particularly super premium wines above $7.50 US a litre at the border. Again, you can see Australia is doing better than any other competitor there if these exchange rate changes we've already seen were to remain for the next 5 years. If we get a further improvement, that will make it even rosier for us. So what does it mean for our export growth? In the volume terms, it's about a 12% growth. That doesn't sound very much, but simultaneously we've modelled exactly what Mark talked about, which is this premiumisation of markets around the world. Everybody consumers everywhere seem to be moving to higher quality and often at the expense of quantity, and that's built into these scenarios, and so we're ending up getting a projected 50% increase in the real value of our exports over as I mentioned, these growth prospects do look better for fine wine. If we just subdivide wine into two categories, that above and that below $7.50 a litre, then you can see, well, we've already seen prices in Australia, Australian export prices into Northeast Asia being well above our average export price. And if our projections were correct, we would get a fraction of our wine exports that are fine by this definition would be rising from 1/9 of our exports to 1/5 by value over this period. So that's what those numbers look like in a picture. Don't expect lots of volume growth, but hopefully some value growth. Where's the changes going to be globally in consumption? For the world as a whole, it's projected to go up slightly rather than be flat. It's been flat for a long time. So the countries like Argentina and a lot of West European traditional producing countries are expected to continue to see a decline in their consumption. The US has got a little bit of growth in there. And China dominates the whole story, though, if you believe these numbers. Just to go back to Mark's numbers, he was showing China pushing along at around 7% a year growth. That was the number today on the news too for the last quarter, maybe overstating it a bit if the government's trying to encourage people, but we are assuming between now and 2020 that there will be just a 5% growth in consumption there, so relatively modest assumption, and nonetheless you get this very big growth. Of course, they might expand their acreage of vineyards more than we're assuming, but we're assuming pretty rapid expansion there at the moment also. So this import demand growth is net of that expansion in the domestic supply in China as well. Where would Australia's exports then be in 2020 compared with today? This is the blue lines are the numbers as of the end of June this year. So it looks like China again would be the growth area, but it's at the expense really of other Asia and the rest of the world rather than our traditional markets. So the UK going down only a bit in this scenario, the US going up a bit in terms of market share. Remember, this is building in all of the growth assumptions of the world economy plus the changes in real exchange rates across the whole world that we are trying to capture. Where would China buy its stuff? Well, it would, according to this, still be dominantly buying from France. Australia would remain second in that market and a slightly smaller share. So this is not exaggerating the story for China as far as we can see, but nonetheless it means a lot for Australia. What about these new bilateral trade agreements that have been signed? We've signed 3. The Trade Minister is also trying to sign 2 more. One is the one with India. I wouldn't hold my breath on that one. I don't think it'll make a big difference quickly for wine. The other bigger one is the Trans-Pacific Partnership of 12 countries. They are meeting in Hawaii in the next 2 weeks to try and sign off on that, or at least get it to completion by the end of this year. So we've modelled the impacts of these simply by reducing the tariffs for the member countries of those agreements. That's probably understating the extent of these reforms or these agreements' impact on the trade, insofar as there are some non-tariff barriers to wine trade that are also being lowered in the process of these agreements. But it's probably overstating it because this modelling is just looking at the wine markets alone. And if all other markets are also being liberalised in our trade with those Asian countries, then that has an intersectoral effect that would dampen those wine numbers that we're projecting. Okay, so what would it do? We've looked at this in 3 steps. The first step is to take account of the FTAs that have already been signed of relevance to the wine industry, and they are Chile and New Zealand signing with China. Chile is also signed with Korea and Japan. So we take all that into account in the first simulation and then compare it with what it would be if Australia, now that Australia has signed with those 3 Northeast Asians, and add that in. New Zealand's about to sign with Korea as well, so we include that. And then the third one is to add the Trans-Pacific Partnership, which will add another set of regional trade liberalisations. So the first simulation is a bit of a negative for Australia. This is New Zealand and especially Chile signing with China, but in Chile's case also with Japan and Korea. So that dampens our export growth into that region to some extent. Of course, you've seen Chile hugely increase its sales in that region as a consequence of signing those things, which was partly what drove the Australian government to try and sign on quickly also, because they thought we could claw back some of that market growth that Chile has taken and maybe excel. So, well, the second set of columns there suggests we would more than claw back. We would, in fact, expand our sales. So what this is telling us is that around 10%, a bit less than 10 on volume, a bit more than 10 in value, would be the extent of the increase between 2012 and 2020 in our sales there. That'd be about 1/10 more. And the third simulation is to add the TPP, this Trans-Pacific Partnership. It doesn't do a lot of extra because a lot of the wine relevant tariffs would have already been reduced in those first two simulations. It just adds a little bit more, and Australia even benefits from that to some extent, according to these numbers. So the takeaway message from this modelling is that these recent exchange rate changes plus China's expected import growth really are going to have a positive impact on the profits of grape growers and winemakers, on the assumption that we do take advantage of these opportunities that are going to be there in the Chinese market. That's a big assumption, because if people sit back and just expect these markets to suck their wine out of their tanks, they're dreaming. Of course, that's not what it involves. It involves huge investments in building relationships in that country for that to have a real effect. But the opportunities, I think, are going to be there. And then these new bilateral PTAs that Australia has signed, and this prospective one that we might sign by the end of the year or shortly thereafter, are going to contribute a little bit more to that. They'll add about a 1/6, mean that our increase in wine export value to 2020 will be about 1/6 bigger than it otherwise would be. So what strategies are required for sustainable growth to actually result going forward? Of course, there are lots of opportunities for firms to push, as Mark suggested, into higher quality ranges of branded wines, and some firms are moving into cooler areas as part of that. And this is taking account of this increasing competition that we've had from particularly Chile. If Argentina got its macro story and politics sorted out, it would be a very strong competitor as well, but it's struggling at the moment because of the way the politics are working there. A second thing firms can do is explore alternative varieties. It turns out that the Australian varietal mix has been getting closer to the global variety mix, that is to say it's more like the French one, which is what other countries have also done. And it's partly because a lot of the rest of the world has taken on Shiraz over the last decade or two, and so we've become less special in that. And as Mark said, that's not a growth variety in the US market, for example, so we do have to worry about that. Also, the varietal mix across regions within Australia is incredibly homogenous. It's very undifferentiated, so it does look like we're not really exploiting terroir differences as much as we might. So this graph shows, for example, that the top 5 varieties in 1990 accounted for half of the bearing area in Australia. 2 decades later, by 2010, the top 5 varieties accounted for 3/4 of our planted area. That's the extent to which we've narrowed the range of varieties that we grow. You can see here the extent of that change. It's been a move toward French varieties, extremely so. They were about 1/3 of our plantings back in 1975. They're now more than 90% of our plantings, with shrinkages in Grenache, for example, which is the, which one is that? The green ones, right? If you want to see the actual varieties themselves, you can see it here. So the bottom two there are Shiraz and Cabernet growing. The reds are below that black line, and the other red one at the top there is the growth in Chardonnay. And the shrinkage has been in Spanish Grenache and also in the Sultana and other things that went into cheap wine back in the 60s and 70s. From an industry point of view, there's obviously more scope for R&D investments. We're currently spending less than 1% of our value of production on R&D. It could be double that and still get a good return from it. And if we do see the industry move into to higher profitability, this is a time where you could vote to expand, to increase your levy and spend more money on that. Promotion is the other thing. It's been talked about a lot. Paul was talking about it on the radio again this morning. The generic promotion spending here in Australia is very small. It's 0.7 of a cent per litre. That compares with twice that coming out of Brussels for European firms, for example, and in Bordeaux, it's about 4 times that. So Bordeaux's wine region is about as big as ours. That's the competition we're facing in terms of expenditure on generic promotion. And of course, we could refine that promotion a bit more too, and in particular stress that we have very good value for money in the finer wine offering and not just in the cheaper end of the spectrum. So I'll leave it there, Peter. Thanks very much.